Let's start with a name most people hear, but very few truly understand. Larry Fink, CEO of BlackRock, the largest asset manager on the planet. Trillions of dollars under management. Influence that extends far beyond markets. Pension funds, ETFs, regulators, governments, entire sectors of the global economy. BlackRock isn't just an investment firm. It's embedded everywhere. Real estate, natural resources, technology, infrastructure, sovereign debt. So when Larry Fink speaks, he's not expressing an opinion. He's outlining a direction. And on October 28, 2025 in Riyadh, he did exactly that. In a carefully worded appearance, he openly discussed the urgency of transforming money itself. Not reforming it, replacing it. Fink didn't talk about speculation. He talked about necessity, the need to digitize central bank money, the need to tokenize financial assets, the need to convert ownership, value, and exchange into programmable systems. In simple terms, no physical cash, no traditional settlement delays, no friction. Just digital flows, instant, traceable, automated. Money moving like messages. At first glance, it sounds efficient. Faster transactions, lower costs, global access. But efficiency is never neutral, because systems that move faster also control faster. And Fink himself acknowledged something critical. This transition is happening too fast. Most nations are not prepared. The existing system cannot absorb the shock cleanly. Which raises a question nobody on stage asked. If the world isn't ready, why accelerate it? History offers a pattern. Large systemic changes are never adopted voluntarily. They are adopted after failure. A problem emerges. Confidence collapses. A new system is presented as the solution. And suddenly, what was once unacceptable becomes inevitable. This is where today's analysis truly begins. Because at the same time BlackRock outlines a digital future, the U.S. Federal Reserve quietly shifts course. On December 1, 2025, the Federal Reserve is expected to reverse its quantitative tightening. For 3 years, liquidity was drained. Balance sheets shrank from nearly $9 trillion to $6.6 trillion. Officially, this was about fighting inflation. Unofficially, it produced something far more dangerous, a fragile banking system running on fumes. Now the reversal begins. Every dollar from maturing treasuries and mortgages will be reinvested. Liquidity returns, not as rescue, but as containment. Because stress signals are already visible. Repo markets tightening, regional banks leaning on emergency facilities. Liquidity behaving exactly as it did in September 2019. The difference? This time, the intervention is premeditated. Preventive. Which leads to an uncomfortable thought. What are they preventing? September 2019 was followed by something else, a global crisis. And today, analysts describe the current system as 2008 multiplied. More leverage, more debt, more interconnected risk. In 2008, the fault line was housing. In 2025, the fault line is money itself. Then comes the detail that changed how many observers interpreted everything. In July, Larry Fink sold $30 million worth of BlackRock shares. Weeks later, he stepped away from direct corporate leadership and moved closer to the center of global governance. The World Economic Forum, officially a career transition strategically, a transfer of power from corporate execution to technocratic coordination. When executives exit management and enter governance, they're not leaving the system. They're positioning above it. Something else happened the same week. The Federal Reserve shifted its stance. Not in markets, not in legislation, but in media. Andrew Sorkin, one of the most recognizable financial journalists in the United States, appeared front and center, opening the New York Stock Exchange. Symbolic. Carefully timed. Days earlier, Sorkin and Larry Fink shared the same stage on 60 Minutes, one of the most influential interview platforms in the country. The message was subtle, but consistent. Stability, responsibility, leadership during uncertainty. To many viewers, it felt reassuring. To analysts watching patterns instead of headlines, it felt coordinated. Because when financial power, media authority, and central banks align their messaging simultaneously, they're not informing, they're conditioning. Conditioning the public to accept instability as management, collapse as normalization, and emergency measures as foresight. Which leads to a critical question. What exactly are they preparing people to accept? While capital reorganizes quietly, something very different is happening at the base of society. The U.S. social fabric is beginning to tear, not suddenly, not explosively, but structurally. On November 1, 2025, a key pillar of American social stability expires: SNAP benefits, the largest food assistance program in the United States. Millions of households depend on it, not for comfort, but for survival. With its expiration, grocery chains begin reinforcing storefronts. Retailers openly discuss the risk of mass unrest. Urban centers prepare for shortages, not of food, but of order. This isn't speculation. It's contingency planning. And when governments deploy contingency planning before chaos emerges, it suggests expectation, not fear. Statements from federal leadership follow quickly. National Guard mobilization. Law enforcement readiness. Public messaging framed as precaution. But precaution against what? Food insecurity doesn't remain passive. It metastasizes. Loss of assistance erodes trust. Loss of trust fuels informal economies. Informal economies breed instability. This isn't collapse through explosion. It's collapse through erosion. And erosion creates something more dangerous than panic: resignation. At the same time, households are tightening, credit is contracting, banks restrict lending, consumers exhaust savings. Small businesses suffocate. Yet one sector explodes upward: artificial intelligence. In the first half of 2025, AI-driven investment accounted for 31% of U.S. GDP growth. Just 1 year earlier, it was barely 12%. This growth is not labor-driven. It is not consumption-driven. It is capital-intensive, automation-heavy, and job-destructive. The paradox becomes unavoidable. The economy is growing, while people are disappearing from it. Major technology firms begin mass layoffs. Not because of losses, but because of optimization. Workers are removed to fund data centers, GPUs, computational infrastructure. Every round of layoffs finances another layer of automation. And the logic is brutal, but efficient. Human salaries are converted into silicon assets. This isn't corporate failure. It's strategic replacement. Traditional industries follow. Retail, logistics, design, customer service. AI systems absorb roles at a pace regulation cannot match. Employment doesn't decline evenly, it collapses asymmetrically. And asymmetry breeds unrest. As jobs vanish, something else concentrates: ownership. Market value no longer rewards production, it rewards control over computation. Those who own servers, energy, algorithms extract disproportionate value. Those who sell labor become redundant. This isn't capitalism collapsing. It's capitalism consolidating. As Catherine Austin Fitts once observed, not a breakdown, a final concentration. But even unlimited capital hits one immovable constraint: energy. AI doesn't run on ideology, it runs on electricity. Data centers devour power. Utilities reach saturation. Grid connections are delayed. Entire projects stall, not due to funding, but capacity. This creates a new hierarchy. Access to dispatchable energy becomes strategic leverage. Natural gas infrastructure, pipelines, turbines, midstream operators quietly emerge as the backbone of the digital era. While public discourse fixates on green transitions, the digital economy runs on gas. The irony is absolute. Act 14, the new oil midstream energy firms don't extract fuel. They control flow, and in constrained systems, flow is power. Every data center depends on it. Every AI model feeds on it. This is why capital migrates silently, not into production, but into infrastructure choke points. The modern economy isn't built on goods. It's built on bottlenecks. Step back. Observe the pattern. Central banks inject liquidity, not to heal, but to delay rupture. Corporations automate labor, not to innovate, but to consolidate. Governance structures centralize, not to serve, but to manage fallout. Energy systems reconfigure, not for abundance, but for prioritization. The real economy hollows out. GDP becomes statistical, growth becomes sectorial, prosperity becomes abstract. This is not recovery, it is transition management. And what's publicly branded as financial stability functions privately as architectural preservation. The system is not being saved, it's being restructured. Human labor is replaced by code, physical money by digital rails, autonomy by programmability. This isn't accidental. It mirrors precisely what the World Economic Forum defined years ago: The Fourth Industrial Revolution. Stakeholder capitalism. Digital identity. Algorithmic governance. A system where participation is conditional. Access is permissioned, and exit is theoretical. Larry Fink did not leave the game. He moved to the command deck. The Federal Reserve is not fighting inflation. It is defending architecture. Media isn't reporting collapse. It is narrating adaptation, and the public isn't being informed. It's being prepared. For the average citizen, the experience is simple. Jobs disappear. Credit tightens. Food assistance vanishes. Energy costs rise. Trust evaporates. What feels like chaos is sequencing. 2008 was rehearsal. 2020 was acceleration. 2025 and 2026 are execution. This time the machine doesn't panic. It calculates. This is not a sudden crash. It is a managed descent, from productive economy to algorithmic economy, from human capital to data capital, from free markets to administered systems. The future is not uncertain. It's being engineered. The only unanswered question is not what happens next. It's this: who will still be standing when the transition is complete? If this analysis unsettled you, that was the point. Because what's coming isn't meant to feel comfortable. It's meant to be misunderstood. Most people won't question it. They'll adapt to the surface changes, without ever seeing the structure underneath. Here, we don't follow headlines, we follow patterns. We don't react to noise. We analyze power. If you want to keep understanding what's being built, quietly, strategically, and far ahead of public awareness, you already know where to be. This channel exists for one reason: to document the transitions before they're explained away. The next phase is already unfolding, and silence has never been more revealing.